Ever thought about investing in real estate but don't know where to start? You're not alone. Many people are drawn to the allure of real estate investing, enticed by the promise of lucrative returns and the security of tangible assets. But real estate investing isn't just about buying property and waiting for the profits to roll in. It's a strategic process that requires careful planning, thorough research, and a clear understanding of the market. The world of real estate investing is vast and diverse, offering a myriad of opportunities. Whether it's residential, commercial, or industrial properties, each investment type comes with its own set of rewards and challenges. It's a game of numbers, where success hinges on making informed decisions and managing risks effectively. But don't let this intimidate you. With the right preparation and knowledge, you can navigate the complexities of real estate investing and reap its potential benefits. So where do we begin? It all starts with education. Step 1. Educate yourself about real estate investing. It's like learning a new language. You need to understand the alphabet first, then the words, sentences, and finally, the context. The real estate market fundamentals are your alphabet. They give you the basic understanding of how things work, the dynamics of supply and demand, and the factors that influence property values. From there, you move on to the words and sentences, which are the different investment strategies. Each strategy, whether it's flipping houses, rental properties, or real estate investment trusts, has its own set of rules and nuances. Then comes the context, the local regulations. Every market has its own rules, and not knowing them can lead to costly mistakes. So how do you learn all this? Well, there are plenty of resources out there. Books, seminars, online courses. They all offer valuable insights and learning opportunities. With knowledge in your arsenal, it's time to set clear goals. Step 2. Define your investment goals. Knowing your objectives is like having a compass on a journey. It guides your investment strategy, whether you're aiming for long-term wealth accumulation, seeking passive income, or hunting for short-term gains. It's essential to be clear about your goals, as each path requires different approaches and levels of commitment. So take a moment to reflect on what you want from your real estate investment. With clear goals in mind, it's time to ensure a solid financial foundation. Step 3. Build a solid financial foundation. Think of this as the bedrock upon which your real estate investing journey stands. It's crucial to ensure your personal finances are in good shape before diving into the world of real estate. This starts with paying off high-interest debt. Credit cards, personal loans, or any other forms of debt that could potentially hold you back. Next, consider establishing an emergency fund. Life is unpredictable, and having a safety net can provide peace of mind, especially when you're making large financial commitments like buying properties. Lastly, don't forget about budgeting. It's not the most exciting part of personal finance, but it's arguably one of the most important. A well-planned budget can help you keep track of your income, expenses, and savings, ensuring you're financially prepared to make the leap into real estate investing. With a solid financial foundation, let's move on to choosing the right location. Step 4. Choose the right location. Now let's dive into the importance of location in real estate investment. You see, location is often considered the golden rule of real estate, and for good reason. A property's location can significantly impact its value and profitability. Think of it this way: you're not just investing in a property, you're investing in a community. You're banking on its growth potential, its safety, and the quality of its schools. So, do your homework. Is the area experiencing economic growth? Are businesses moving in, or are they leaving? What's the crime rate like? Are the local schools highly rated? Is there potential for future development? Understanding these factors can help you anticipate the demand for and value of your property down the line. Remember, a great property in a poor location can be a poor investment, so choose wisely. Location decided, it's time to choose the right property type. Step 5. Select the property type and calculate the numbers. As we dive into the world of real estate investment, one of the first decisions you'll need to make is choosing the type of property you want to invest in. From residential and commercial to industrial and mixed-use properties, each comes with its own set of advantages and risks. Residential properties, for instance, can provide a steady stream of rental income, while commercial properties often offer longer lease terms and greater income potential. Industrial properties, on the other hand, can be less management-intensive, while mixed-use properties offer a blend of both residential and commercial tenants. But remember, no matter the property type you choose, it's crucial to run the numbers. performing a thorough financial analysis before making a purchase can help you avoid costly mistakes. Consider the purchase price, financing costs, property taxes, insurance, maintenance, and expected rental income. Also, don't forget to factor in potential vacancies and unexpected expenses. Creating a comprehensive financial model will allow you to see if the property will be profitable and meet your investment goals. Remember, real estate investing isn't about taking wild guesses. It's about making informed decisions. Running the numbers not only helps you understand the financial implications of your investment, but also enables you to compare different investment opportunities. With the numbers in hand, let's explore financing options. Step 6. Consider financing options and diversify your portfolio. In the real estate world, funding can be acquired through various sources. Traditional mortgages are quite common, where you borrow money from a financial institution, paying it back over time with interest. Alternatively, private lenders can offer more flexible terms and quicker access to funds, but often at higher interest rates. Then, there are partnerships. Pooling resources with others can reduce individual risk and increase purchasing power. But remember, while investing in real estate can be lucrative, it's not wise to put all your eggs in one basket. Diversifying your portfolio is key. This means spreading your investments across different types of properties and in different locations. This strategy helps to spread the risk. If one property underperforms, others in your portfolio might do well, balancing things out. Ultimately, a diversified portfolio can offer more stability and potential for long-term growth. Financing sorted, let's plan for unexpected expenses. Step 7. Plan a realistic budget and decide on property management. Real estate investment is not a set-and-forget venture. It requires active management and a realistic budget that accounts for unexpected expenses. These can range from sudden repair needs to periods of vacancy. Your budget should not rely solely on projected rental income to cover all costs. Instead, it must include a contingency plan for these potential outlays. Equally important is deciding how to manage your property. Will you take on the task yourself or hire a property management company? Remember, effective management is crucial for tenant satisfaction and long-term profitability. If you decide to manage the property yourself, you'll need to be prepared to handle everything from tenant complaints to maintenance issues. On the other hand, hiring a property management company can free up your time, but it will also add to your expenses. Budget and management sorted, it's time to understand local regulations. Step 8. Understand local regulations and build a network. It's crucial to familiarize yourself with the local landscape where you'll be investing. This includes zoning laws, rental regulations, and tenant rights. Zoning laws dictate what types of properties can be built in certain areas, and rental regulations define the rights and responsibilities of landlords and tenants. Understanding these rules will help you avoid legal troubles and ensure a smooth operation of your investment. But remember, you're not alone in this journey. Building a network of real estate professionals is equally important. This could include realtors, contractors, other investors, and even legal advisors. These individuals can provide you with valuable insights, resources, and opportunities that you might not come across otherwise. They can also offer advice based on their own experiences and mistakes, which can be invaluable. With a strong network and knowledge of regulations, it's time to stay informed. Step 9. Stay informed and monitor your investments. In the ever-evolving world of real estate, staying up to date with market trends, economic developments, and changes in real estate laws is crucial. This knowledge isn't just informative, it's the compass that guides your investment decisions. From recognizing a promising opportunity to averting potential pitfalls, being informed helps you navigate the market's choppy waters. Regular assessment of your investment performance is equally important. It's like a health check for your portfolio, allowing you to spot trends, identify opportunities, and address any issues early on. Remember, it's not just about making investments, it's about managing them diligently and proactively. As we wrap up, let's reiterate, real estate investing isn't a sprint, it's a marathon. It requires patience, perseverance, and long-term thinking. So take your time, make informed decisions, and keep your eye on the prize. Remember, patience and long-term thinking are the keys to successful real estate investing.